So if you bought a home in the last few years, there's a 92% chance that you have an interest rate under 6%. And if you have that, there's a really good chance that you're not going to be selling anytime soon. And I know that a lot of people are wondering if we're going to have housing crash. And let me just share with you, for a couple of reasons, which you might be surprised, my prediction is no. Of course, nobody can see exactly what's going to be going on in the future. I was selling real estate in 2008 when that whole fun thing happened. And let me share with you, I don't think too many people knew exactly how bad it was going to be. And if you ever watched The Big Short, it's a great movie about that. It actually took me a while to watch it because I was having a little PTSD because that was a tough time to be a real estate agent. But that particular movie really lays it out because even people who were in the know didn't know how bad it was going to be. So I thought I would take a little bit of time to talk about so you're just getting flooded with all this information and the likelihood of crash. And so there's a lot of buyers waiting for a crash and or B, a rate reduction, or both, right? I don't know how much either of those two things are going to happen anytime soon. And the reason I thought to make this video was because of the Fed coming out and saying that since there was there wasn't just no, what's the word I'm looking for, like relief in the inflation, it's at 3 and they want to see 2. So we're not going to see a rate cut coming anytime soon from them. Now, does a mortgage rate, is it exactly affected by that? Actually, no. I'm really not the best person to explain that whole thing, but let's just say it is not a direct line, okay? But it's an indicator, right? So if rates are going to be where they are for a while, and maybe in the 6s, I don't know. I mean, I don't know, but I'd like to see them, for everybody's sake, get down into the 6s, and that would be nice to see. So that's what I wanted to start with. Just FYI, we have a situation right now where there are so many people that are locked into their homes because they have an interest rate, and they're locked in the sense of, if you have an interest rate at 3.75 and you would like to move, you're probably not going to. You're just not. I mean, I've had people try to teach me scripts to try to talk to sellers and talk about, well, why you should move. Well, I mean, quality of life and all that stuff. I get it. There's some valid reasons to still move, regardless of the fact that you have this interest rate. One of those reasons is that if it's not going to be going down anytime soon, and this really is affecting your quality of life, then yes, maybe you have made enough money in your house that, depending on where you're going to move to, maybe that amount of money is enough to buy down the house that you're going to. I mean, if you're moving like from California to, I don't know, Ohio, there's a really good chance that you are going to sell your home here for way more than the home that you're going to buy. Okay, so when you buy that home, there's a really good chance that you're going to have a lot of money to put down. And when you do that, then you're going to be able to still be paying a payment that isn't that bad. Okay, so there's those arguments that are valid. They're legitimate. If you've been living here and your grandkids are in Ohio, let's just use that example again, then yes, moving and going ahead and sucking up a higher interest rate might be worthwhile. And your payment may not change, again, because of that difference. You have a lot of equity here, you're moving it over there on a lower home price, you put in a big chunk of equity. Now all of us, or you're just buying cash, right? I mean, maybe you sell enough here and then you can just go over there and you can buy something for cash, and who cares about the interest rate? So maybe there's that as well. But anyway, the point is, though, is that we do have a lot of people who are not going to be putting their homes on the market for what some of the normal reasons would be. We want to stay in the same area, but we just, we would like to be on in our case, maybe a better golf course. Or we want to be in the same area, but we might want to be, we want to have extra bedrooms. We want to have less bedrooms, right? Our family's getting bigger, our family's getting smaller. It's just more convenient. We really are tired of dealing with 3 kids in a 3 bedroom, etc. So those are the kind of things that are likely not going to be getting people on the market. So you've got limited inventory because of that. You also have a limited inventory because of the fact that builders have not been building as many homes as they've needed to for many, many years. They're starting to catch up, but they have so many years in the hole they have to dig out of that it is just really unlikely that we're going to see that changing much. And let me just show you what I mean by that. So switching my screen here, got to put the glasses on. All right. So let's talk about that. So we have got a situation where in 2008, most of us know what happened. We didn't have quite enough homes for the population at that time. And I heard somebody today on a podcast that I like to listen to. And they talk about a lot of this stuff that is really, it's kind of stats. It's for us nerds who like spreadsheets and things like that. At least, I don't want to insult them. I'm a nerd and I like a spreadsheet. So hopefully that's not insulting because I'm talking about me. But I was listening to him talking about the inventory, how that is the issue, that if the rates go down, or that's what's creating the crisis. And he said, well, it's not an inventory crisis, it's a home affordability crisis. Well, kind of, but not 100%, because he talks about, well, it's a supply thing and the builder's not building, that's really not what it is. It's the affordability. Okay, I would argue that the affordability problem has been spurned by the lack of building because of basic economics of supply and demand. If you don't have enough homes for the population, even right now when homes are sitting longer and you might have a little bit more supply to look at or whatever, the fact is that we are still not seeing the kind of supply that would actually push prices down. So it's a twofold problem. We don't have enough homes, and we haven't for years. And if we would have kept with the building, if we wouldn't have had the Great Recession, then we would have probably kept up with building, and we probably would not have seen, and I'm just speculating here, that huge run up during COVID where people with the low interest rates were created to help keep the economy going during COVID, right? We were already starting to see at the end of 2019 and into 2020 a little bit higher interest rates. I remember saying, I'm kind of excited for that to happen. And at the time we were thinking 5. And I was kind of excited for that to happen because I was thinking, well, you know what that means? It means that we are going to see more inventory come on the market. And finally, we'll be able to breathe a little bit, and we won't have to, like, as soon as a house comes on the market, I'm literally practically like putting a bite of food in my mouth. And I'm like, somebody's like, oh my God, this house came on the market. And I'm like, I almost have to put my fork down and go show it to them, or they're not going to get it. I mean, not really, but it was close. I mean, you really had to get out there and you had to run and go show these properties. And in 2020, once the first few months kind of shook out and we knew what was going to happen, it just went bonkers because the rates were so low. And then we had a situation where and people didn't want to sell their homes too because they didn't want people walking through their homes and potentially getting them sick. And then that was a thing for a little while as well. And so you had a lot of people being able to move. They're working from home. A lot of the people who were doing that were able to buy. So in any case, it just created this perfect storm of a situation where you just had, we were down to so few homes, as a lot of you know, that it was multiple offers, almost every home that came on the market. If you were anywhere in the vicinity of a reasonable price and there wasn't something particularly strange about your property, you were going to get multiple offers and you were going to get them very quickly. So that ate up a lot as well. Okay, so here's what I'm talking about. So you've got a situation here. If you look at the numbers here, so if you go back into the 80s, right? They were not, I mean, look at the 80s versus here's the problem. And I wish I could do this and it wouldn't pop up the little thing. But this right here, that's the problem. So from 2000 and here we're 2005 or 2006, 7, and boom, fell off a cliff. I was sitting in a new construction site in 2008, and this is real. The builders, I was in Washington State at the time, and it was actually really sad. There was literally homes just sitting. There's big, developments, and there's homes with they're just molding. Actually, they just sat there, and the builders went out of business. It was a horrible time, and it was really, like I said, a little PTSD. It was a tough time to go through, but you've got to think about the fact that that has directly impacted. So the combination of this right here, this gully, if you watch, the Big Short, that she talks about the gully, that was a big gully. So that right there is another thing that is affecting supply. So you have the fact that builders didn't build for like a decade, at least at the even close to the normal rate. Okay. B, you've got a lot of people who are locked in, quote unquote, to their homes, who have a low interest rate and just aren't going anywhere. They're just not going to. I mean, now there's arguments to be made, but there's just a lot of people who they haven't even discussed it because it's not even an option in their mind. So now what we have is a situation where our inventory is not going to let up anytime soon. The lack thereof, right? It's just not going to let up anytime soon. So let's talk about what happens next. Here is JP Morgan. This is the key takeaways that they're coming up with that I think most people would agree with. So they expect that the housing prices will rise by 3% overall in 2025, even though, and this is interesting too down here, the US housing market is likely to remain largely frozen through 2025. Some growth is still expected, but a very subdued pace of 3% or less. But here's the thing, even with the interest rates, which right here too, the higher for longer interest rate backdrop is here to stay, with mortgage rates expected to ease only slightly to 6.7% by year end. Okay, so what does that mean? It means that this idea that, rates are going to all of a sudden drop into anything that's going to be much different than what you're looking at right now is unlikely. And even though it's not going to go up that much, 3%, 4% a year is average. It's average historically over the last, 50, 60, 70 years. So 3% is just about normal. It's just not what the normal has been for the last few years. So if you think about the fact, now if rates do go down, if something happens, right, and the rates do get lower than 6.7 and they get closer to 6, or if they get in the high fives, the idea that they're going to be even that is unlikely. Let's just say it does. Well, now we are back to having multiple offers, most likely because of all the buyers who are sitting on the sidelines. Once that rate shows up and they were watching their morning news and they're having their coffee and they say, oh my, the rates are at 6. Well, okay, well, let's go, right? Let's go buy the house. Okay, there's not just one or two people who are in that boat, right? So that is what you want to think about. Who are you going to be competing with again? Only before you were competing with other people with interest rates in the 3s, right? Or even 2s in some cases, depending on the type of loan you're getting. Now you're competing with people who, and the rate is 7, so, or 6 or whatever. I know them, marry the house, date the rate. Not a huge fan of that saying, and somebody else was saying that too. It's because I don't know if the rates are ever going to go down lower than if you got like a 6.7 today, or you were able to do, like, get the sellers to do a buy down or something like that. If you were able to get that rate today, would you be able to then turn around and refinance down the road? I mean, maybe someday, but I'm not going to tell you that you're going to be able to do that. What I am going to tell you, though, is that the only thing that seems inevitable at this point is that the prices aren't going to come down overall. Are there particular pockets where you might see the prices dip back down? Sure, probably not by much, but it's hard to time that too. So if you're thinking of ownership long term, I mean, if you're trying to flip a house or you're trying to do something like that, then this is not a good idea. But if this is your home, if you want to buy and own a home that you're going to, be able to build wealth in, because again, yes, the rates are higher, but it's now yours. And when the prices go up, and they do over time, even people who bought right before the Great Recession, within 5 years, they've made money. And it didn't seem like you were ever going, oh man, there was some there was some tough times in there. But they had made money. And so you have to consider the fact that you've got a situation here, and let me just see if I can use this, that even though it's likely to remain frozen through 2025, but what does that mean for you? It means that if you're a buyer, right, this is directed at the buyers right now. If you're a buyer, what's the good news? Right now, you've got some power. You didn't have power for about 5-6 years. And even when a really good home comes on the market right now and it's priced well and everything, you've got some power. Or you don't have as much power, is what I mean. But for all the rest of them, you have some power. People who have their homes on the market, they want to sell. They know it's a little tougher out there right now. There's homes that I'm seeing that they're on the market for 140 days right now. But that's not all. They were listed before for 80 days or whatever. So they've been on the market. They want to sell their home. I know when I talk to sellers a lot, and I don't, if you've said this, I'm really not meaning to sound like I'm not making fun of anybody, because I get it. But when people say, well, I'm not giving my house away. Well, the fact is that you're not. You're selling it for the current market value. It might feel like you're giving it away because you are not selling it for what you would like. You're maybe taking a little bit of a loss because you just bought it a couple of years ago. I see this more with people who invested, especially like in short-term rentals around our area. They tend to, there was a little oversaturation going on. So while there's still plenty of people renting short-term rentals, got lots of Airbnbs, people, come to the desert and they want to stay in a home. So there's still a great market for that. There's just an oversupply of rentals. So then some of them turned into long-term rentals, and some of them are just trying to sell and get out from under this investment that did not turn out the way that they had hoped, most likely. So that's what we're seeing. All right. So existing home sales and inventory remain low. So what did we just talk about? This, right? So we've still got, inventories down here. As you can see, this was the high sales because inventory was low, right? So this is all the people getting in on those low interest rates. Well, the actual inventory, and this right here, this difference is why you had 10, 20 or more offers on one home the minute it came on the market. It's this gap right here, right? So that's interesting. And then it's interesting too, because the inverse happened here, right? So we had such a high inventory after the Great Recession, during the Great Recession, right? And it just started to ease up right about 2014 into 2015. It was pretty neutral there for a while. And then whoosh, super seller's market. So right here, if you look at 17 to 21, okay, that was a seller's market. That was a good seller's market. People were still, I had a buyer one time, she called me, she's like, I give up. I'm not looking for homes anymore. I'm so tired. I'm so tired of making offers and not getting it. There was one particular home that she really liked. I knew the agent. The agent called me. We had already talked about it. She said, hey, this house is coming back on the market. The buyers couldn't perform. And we were able to slip it. And she ended up getting the house that she really, really wanted. And that was in 2020. But so I'm really happy for her because she is in this arena here too. But this right here, this was unsustainable. It's just unsustainable. And this is also a lot of the reason for inflation. So, right, that the housing, the cost of housing is part of the reason for inflation. And it's also why everything got more. Anyway, that's a whole other thing that I am not qualified to talk about other than just broad strokes. So this right here is what I really want people to understand. This is the problem. I don't know why this won't draw, but anyway, that's the problem right there. Now, here we are. We're in this little like existing housing inventory. The inventory is still low, but the sales have gone down. This right here, right there, right? Okay, it's not going to do it. This right here is interest rates. This is low interest rates. This is high interest rates. The inventory has been low the whole time. So it stands to reason if the rates go down, there's a really good chance that they're not going to go like this again because they're not going to be as low. But they're going to go up. And therefore you could see potentially if that happens. But I suspect that the person who wrote this article is probably right. We're going to continue to be in sort of a neutral market. Inventory is low, but the rates are high, which is keeping it just like, well, if you've got to sell, you might have to put your house on sale, not just for sale. But what does that mean? If you bought your home, anytime in the last, I don't know, a couple of years, I mean, if you bought it just 2 years ago, rarely do you ever make any money anyway if you buy a home and you only have it for 2 years. Historically, it's kind of a crapshoot. I mean, that's a gambling situation right there. Whether you're actually going to end up having, you just bought it exactly the right time and boom, you bet on black and it hit black, right? I mean, that's what you're looking at. Otherwise, housing is a long-term investment. It always has been. So if you were to buy now, at least you would get that 3% gain, or maybe in 2026, it's a 4% gain. Maybe in 2027, it's a 7% gain. I don't know. But the fact is that if you're going to stay in that home for 7 years, 10 years, that's the average, 7 to 10. Used to be about 7. Now it's closer to 10. You're going to stay in that home for that amount of time. You are going to reap the benefits. You just are. And rent's only going to continue to go up. There's just no other place for it to go with everything else getting more expensive. It's more expensive. The HOAs go up. The taxes go up. I mean, everything goes up. So your rent's going to go up. And if you're in a place where the corporation owns an apartment building or something like that, I mean, they're just going to raise your rent because they can, because there's people who will pay it. So that's my thoughts on that part right there. So what's the end result? If you're waiting for prices to come down, as you can see, they're unlikely to. They're not going to go up as much, most likely, but they're also probably not coming down, right? So if you're a seller, and again, if you're a seller who has owned for a few years and you want to sell your home, you might have to sell it for less than, I see people too, they're talking about, and I just did a video on this as well too, about the actual year over year rates. They went up 4% in the Coachella Valley last year. The home prices, the year over year that I did right at the end of the year, or right at the beginning of the year rather, showed that the overall values went up 4%. Again, there's some microclimates in here too that will be a little bit different than that. But if you did not, I hesitate to say overpay, it is what it is. If you bought a house in 2023, perhaps there's a little bit of that going on or not. But let's face it, as long as you're not going to need to sell it right now, by the time you've lived in that and it's 2033, chances are you've made a really good amount of equity at that time, because that's how the cycles go, right? So at the end of the day, you have basically a locked-in payment other than insurance and taxes, potentially changing that as long as you didn't get an adjustable rate. You have a fixed rate, you have a locked-in payment. And so you know that your housing price is going to be give or take this amount. Okay. So as a seller, though, if you do need to sell right now, and what I started to say, a lot of people think, they say, well, prices have come, I see prices are just dropping all the time. You're not seeing sold prices dropping. You're seeing homes that were on the market for too much money having to come down and meet the actual market value. Okay, so there's a difference, right? So you've got a price that you put your home on the market and you say, hey, I just feel like this is what prices have been doing, and I should be able to get, I see my neighbor's house is listed for 750. And that's what happened. And again, and I am not, I'm in this every day, and most people don't only do this about 7 to 10 years, right? So they say, well, I've seen my neighbor's house is on the market for 750. And then this one over here came down to 695. Well, that wasn't a market drop. That was a listing drop. That was a home that was listed too high. And again, what I'm seeing a lot of right now is I'm seeing a lot of people who bought for investment purposes for short-term rentals in the valley, that what I would say, overbought. They bought too high. And now and then maybe, they put a pool in, and then they did all these things. And now, and it's heartbreaking, because I saw a lot of this too with people who were doing, investing on a, smaller basis in like the 2005, 6, 7, and then having that sort of crash as well. That crashed big time, but that actually was a crash. But in this particular case, we saw a lot of people buying for these short-term rentals, and then having that not really work out, but they put a lot of money into these short-term rentals, and now they're just not getting it back out because they want to turn around and sell it right away. If they were holding it for long-term, different story. So I hope that has helped break some of that down. If you're a seller right now, you are likely fine. You've made some money, maybe not as much as you were hoping, but you have probably made some money and can probably sell and make a profit and move on if that's what you want to do. If you are a buyer, I don't know that there's any reason to wait unless it's inappropriate for you to buy a house right now. But if you have the means and you are able to, it is very likely that if you buy it right now and you live in it for the normal 7 to 10 year range, you're going to make money. And you're going to have a locked in payment, and you're probably going to turn around in 5 years and look back and say, wow, look what rents are right now. I am so happy that I bought this house. As a matter of fact, I could probably rent my house for more than well over my mortgage payment right now. I mean, those are the kind of numbers that I think you're going to see. Of course, the longer you're in, the better. Now, something else to consider too is getting a 15-year fixed if you're able to. A 15-year interest rate is going to be lower than a 30-year interest rate. So if you can manage that, and I know, and the payment's going to be higher, but the interest rate's going to be lower. And obviously it's 15 years versus 30. And if you do the math on that, the amount of money that you're going to be paying down, it's like a forced savings account. The amount of money that you're going to be paying down on that mortgage is going to benefit you, so that let's say you do want to sell in 5 years or 7 years, you're going to have so much more of your home paid off and so much more equity to tap into to move to the next property than you would have had with a 30-year fixed. You're going to have such a big chunk of that loan paid off because you're going to be a third or a half of the way through. So something to keep in mind. Anyway, I hope that has helped. I think that if you obviously are thinking, if you're watching this video, you may or may not be thinking about making a move anytime soon. If you want to get on a Zoom with me and chat about your specific situation, because everybody's got a little bit of a different scenario going, I would love to talk to you. And I've got my link below. There's no obligation. it's just my opportunity, like these videos, to just kind of show some value and, give some of my, it's just my opportunity to show some value and be able to give back to the community that's given me so much. And I really do enjoy real estate and I like talking about it. So I'm happy to talk about it with you. So I hope you have a great rest of your day or evening. And I hope to hear from you. And also, if you have any questions or comments, I'm always really looking forward to seeing and hearing them in the comments below. So have a great day.